What's up, guys? In this video, we are going to cover the RSI, also known as the Relative Strength Index indicator. Now, the reason why we're going to be talking about the RSI is, number one, a majority of professional traders use this indicator. The RSI is the most widely used indicator in all of trading. Okay, so immediately that should tell you there's a strong reason to use the RSI, okay? Now, the other key reason why we want to use the RSI is it is a momentum indicator. And what that means is the RSI, in a very basic sense, the RSI takes an average across the market, whatever particular pair you're in. So for right now, we're in USD JPY. So we're in UJ. What the RSI will do on UJ, see here, the RSI is here at the bottom, okay? And I'm going to show you guys how to add that on TradingView. Actually, we covered it in the last training video, but I'll go over it again for you. The RSI is going to average out price and determine the momentum of the market, or the strength or the direction that this pair wants to move in. So what I'm going to do now is I'm going to actually break down the RSI, exactly how it works, and then how you can use it as a confirmation in your trading decisions. Now, I want to say this before I get into the details of how it works. Do not use the RSI as the main reason for taking a trade. I know when I first started trading, and many of you that are just starting now, you may have experienced this where you see the RSI in either the buy or the sell zone, and you say, I'm just going to place a buy, or I'm just going to place a sell when it hits that zone. However, you need to make sure that you're using confirmations when you take trades. Does it line up with your market structure? Is it hitting a trend line? Is price action moving in your favor? And then on the RSI, is it in one of the zones that you need in order to confirm the trade? Okay, so again, this is a supplemental indicator. It's going to supplement your trading idea. It's going to give you a confirmation whether or not to take a trade, but it won't be the main reason why you take the trade. Make sense? All right, so let's break down the RSI. I love this indicator. I mean, really, you guys, trading is so simple. It blows me away how, you know, there's just folks out there that like to use a million different indicators and all this different stuff, and they're waiting for 10 different things to happen. When in reality, you guys, you really only need one or two indicators. All right, outside of what I just taught you with market structure and price action, all you really need is one or two indicators just for confirmation. So let's talk about how the RSI works. Now, you'll notice here on the RSI, I'm going to make it just a little bit bigger so you can see. If you take a look on the right-hand side, there are levels from 1, goes all the way down to 1. Now, this one's not even showing that low. It actually goes down to 20. But it ranges from 1 to 100, okay? 1 to 100. Now, what you're being shown, which is the standard inputs for the RSI, is 30 to 70. Technically 20 to about, looks like it's showing you about 85, okay? Now, what's important to understand about the RSI is the 50 level is the median, okay? The 50 level is the middle of the range. Okay, the middle of the range. The 30 level is the low end of the range, and the 70 level is the high end of the range. Now, I want you to notice something when we look at the chart and compare it to the RSI. Now, when you look at the RSI, wherever the RSI is, will run vertical to price. What I mean by that is, if we're looking at this part of the RSI, it correlates to that peak right there. I'm not sure what's going on with this trend line here. Oh, I'm on the RSI. That would be the issue. So you guys, when you draw a trend line, make sure it's on the chart, not on the indicator. All right, let me do this again. So from this peak to this peak, so it runs vertical, okay? So this peak right here is showing you this peak on the chart. We can zoom in a little bit. That way you have an idea, okay? So remember, it always runs vertical. So where this price action is happening here, it's being displayed on the RSI right here. Make sense? Okay. So let's talk about how the RSI works and then how we can use it to our advantage to take a trade. Now, what you need to know that's really the most important thing about the RSI are the two zones where you would be confirming a buy or a sell. Okay. Now, this zone up here is known as the oversold zone. So anything above 70 is known as the overbought zone, rather. Forgive me, the overbought zone. Man, not a good way to start the training video. The overbought zone, okay? And down here at the bottom, anywhere below 30 is known as the oversold zone, okay? The oversold zone. So what do I mean by that? When something is overbought, okay, so if we're up here and you see the indicator is above 70, that means that momentum is going to be shifting soon, okay? Because there's been too much buying action that's occurred. Now, if we look at the actual chart, you can see there was a pretty big rally from here to here, right? So what the RSI is telling us is that there's been a lot of buying action that's happened. The buyers came in, they really bought up the US dollar against the yen, and now it may be time for a reversal of trend, okay? So this zone, when you enter into this zone above 70, take a look at where price is at on the chart. This peak up here. And what happened once it hit that peak? It went down, didn't it? It went down because, again, momentum shifted, which is what RSI detects, okay? And it will tell you when a shift in momentum is coming. However, like I said, you don't want to solely rely on that because, as you can see here, price can hang out in that zone for a while before it makes the drop, okay? So what you're looking for is for price to be above the 70 line or, again, below the 30 line. So let's talk about oversold conditions where the price is below the 30 line. Now, when you see price entering into this zone where it's either touching or below, that's considered oversold, which means that the market has gone down enough. The RSI is telling us, hey, look, enough selling has happened. The market's oversold. It's been sold too much, and it needs some relief. It needs to go back up for a little bit, okay? Now, again, you can see it kind of consolidated right there for a minute, but then what happened inevitably? It went up, right? If we take a look, it was at the bottom of the RSI here, right? And then it went up. Now, again, it did pull back, but then ultimately it went back up, right? So keep that in mind when you're looking at the different zones. You also need to see what's going on with price action. What's actually going on with the chart? What are you noticing that's happening on the chart, right? So if we're at an area that may be a resistance, which up here, it appears to me there's some resistance there, and the RSI, and I'm going to go ahead and remove this, and the RSI is showing me that we are in overbought territory, that's a confirmation that it may be time to place a sell, okay? So this is one way to use the RSI, is where you place a buy or a sell in the extreme zones, which, again, the extreme zones are from 70 to 100 and from 30 down to 0, okay? Anywhere in between is the range, okay? It's the mid-range, especially right there at the 50, which is dead in the middle, right? So keep that in mind when you're trading. Now, the tendency that happens here is, like when you see an uptrend like this, okay, so if we take a look at this uptrend, you can see that the RSI was also in an uptrend. Make sense? Do you notice that? So it's very, very similar to what's happening with price. However, the indicator, again, is giving you an overall average. Now, with these inputs, you're going to want to just use the standard inputs where it says 14 and close. That's going to be perfect, okay? That's a 14-day RSI. That's perfect. That's really all you need. Some people use a 7-day. but ultimately you'll want the 14-day to determine whether the market has been oversold or overbought. Make sense? Okay, so again, we're looking for really, really low conditions or really, really high conditions. Now, I want to talk to you about a concept that's kind of advanced, but it's very, very important that you understand this concept, okay? And this concept right here alone is one of the key reasons why we're so profitable with our strategy, okay? And what we're about to talk about is a concept called divergence, okay? Now, the concept we're going to cover here is called exaggerated divergence, okay? And what exaggerated divergence tells us is when market conditions are starting to change, okay? Now, when you see divergence, it's when the RSI is showing you something different than what price is doing. Because remember, there's a correlation. It runs vertical, right? So you need to take a look at differences between the indicator itself and price action. So I'd like to show you an example. Here's a good example here. Beautiful example. If we look over here, at this point right here, we had a nice little double bottom. Actually, okay, nope, that doesn't look like there's any divergence there. Let's take a look over here. I did see one. Right here. Perfect. So there was another nice little double bottom that occurred here, and we had some nice divergence, okay? So I want you to take a look at this for a minute. So if I take a look at this low right here and I draw a trend line, you can see that that's clearly moving down, right? We have a lower low that's happening right here. Do you see that? There's a lower low. Now, if I go to the RSI directly below that, I see a higher high, don't I? Look at that. Isn't that interesting? See how there's a higher high? Price went down, but the RSI told us, wait a minute, this is a move to the upside. What this is called is an exaggerated divergence, which is an indication that the market or price could start reversing, okay? Now, when this happens, it's all based on what the indicator is telling you. So if we're in a downtrend and we're at the bottom of the downtrend and you see this movement here, a nice little double bottom where there's a lower low, but the RSI is giving you a higher high, what that means is bullish divergence, okay? Bullish divergence. Bullish divergence means that the market should go to the upside after that move. And if you take a look here, guess what happened? It went up, right? It did go up. So the bullish divergence played out, and then you can see that it also played out on the indicator all the way to that top. All right? So that's how bullish divergence works, where there is a disparity or a difference between the price action on the chart, the candles, and what the indicator is showing you. Now, these divergence zones can be found right around the 30 mark and right around the 70 mark, okay, in the extreme areas, okay? Now, I want to talk to you about another example, which is called bearish divergence, okay? Bearish divergence. And I see it right here. So let's take a look at this. And this was followed by a pretty big downtrend here. You can see here that price is on an upward angle. But if you look at the indicator, what's happening? That's steep divergence right there. Look at that. Wow. See how that works? Actually, it's happening across the whole top of that. Boom, right there. And then we can even go all the way up to there. You see that? That is known as bearish divergence, okay, or a signal that you should sell, okay? A signal that you should sell, because our momentum indicator is telling us that too much buying has happened and that now momentum is shifting to the downside. And once you have 2 or more points that confirm that, you can place your sell. So if we're really looking at an entry on this, again, we always go with price action. We would enter at the very first bearish candle right here. And that's it. It's that easy. Once you've identified divergence, you will enter at the candle that corresponds with your entry. So if you placed a buy, you're going to go in at the first big green candle. If you placed a sell, you're going to go in at the first red candle. Make sense? This is one way that you can use divergence in order to identify a buy or a sell. But I can tell you from my trading experience, divergence has been a very, very key and integral part of my trading. I'm always leveraging divergence and looking for opportunities that include divergence. My trades almost always contain bullish or bearish divergence. So I want you to think about that when you're looking for trade setups. Again, you're looking for trades that are in the extremes on the RSI, and you're looking for divergence between price and the indicator, okay, between price and the indicator. And remember, it runs vertical, so you just look up. Okay, so I see a higher high here, then I go over here and I see a lower low. That is a bullish signal because the momentum indicator is moving up. And vice versa up here. I'm seeing upward movement, not very much, which is generally how it looks in the price. But then when I go down here, look at how steep this descent is in the RSI. Excuse me, that's telling me we have bearish divergence, right? So it's really that simple, you guys. That's how divergence works, and that's exactly how you can use the RSI indicator in order to take trades. But again, what I just showed you is a very key part. Divergence and the RSI are considered 2 confirmations that we will use in our strategy. However, you want to make sure that price action and market structure are lining up with your trade, okay? So if I have a resistance up here, okay, in this zone above these peaks, and I'm seeing bearish divergence, that's a good indication that I should get into the trade, right? And if I also start seeing a big red candle, I should enter on a sell, okay? And with divergence, 9 times out of 10, eventually, once it gets to a certain point, it's going to play out. It just takes a little bit of time sometimes. That's why it's very important that you use proper risk management and only a maximum of 5%, because you could see the divergence over here and it's still going up and you could get caught in a very small drawdown before it actually makes its move down. That's why it's key that you use proper risk management and that you actually hold your trade either till take profit or stop loss. Make sense? All right, so that's how it works, you guys. Now, when it's in between in the middle here, you're basically just looking at a trend, right? I mean, it's just a trending market when it's in between the 30 and the 70. This is kind of what you can think of as like a heart monitor, right? You know, we see the heart monitor and it's moving within the range. That person's healthy. Oh, I grabbed the wrong tool. The person's healthy when it's going in between the range, right? But as soon as it goes out, I really need to start looking at what's going on with the price. Now here, it's not very extreme, right? It actually did hit a resistance area. You can see that area did provide some resistance and it actually did go down there, okay? But we're not in the extreme. We're really ideally looking for price to be in this extreme zone. So the 2 black zones. Now, yours might look a little bit different because again, I, customize all of my colors for my trading style, but you'll know, when you look at your chart and you look at your indicator, you're going to know where the extreme zones are. And you should be able to easily identify divergence or when price is acting differently than what the indicator is showing you. Okay? So again, you guys, I hope you guys gain value from this video. If you have any questions on RSI, we will go over it in a mentorship call, or feel free to ask in our trading community as well. This is definitely a concept you want to understand thoroughly. So if you have any questions, please be sure to ask in the chats or on a call with me. Thanks a lot for watching this video, you guys, and I will see you on the next one.